The year 2025 shocked the financial world when Nvidia, Apple, and Tesla all plunged nearly 70% in a matter of weeks. Analysts scrambled to explain the phenomenon, but the truth runs deeper than simple market cycles. This was not just a tech sell-off. It was the result of an interconnected financial system pushed to its limits by speculation, debt, and over-reliance on innovation narratives. The first trigger was excessive leverage. Hedge funds, institutional investors, and retail traders have been piling into high-growth tech stocks for years, often using borrowed capital to amplify returns. Nvidia's AI-driven optimism, Apple's recurring hardware and ecosystem profits, and Tesla's dominance in EV and energy markets created a belief that these stocks were unstoppable. Margin loans and derivatives multiplied exposure across the financial system. When any shock hit, it didn't merely affect individual portfolios. It cascaded. Global macro conditions accelerated the crash. Rising interest rates, tightening credit, and slowing economic growth undermined the high multiples these tech giants carried. Stocks valued for growth rather than profit are particularly sensitive to rate changes. Suddenly, the cost of capital skyrocketed, and projected future earnings discounted to today's value dropped sharply. Investors fled. The more leveraged the position, the faster the sell-off. Algorithmic trading intensified the fall. High-frequency trading systems monitor price momentum, volatility, and liquidity. When Nvidia, Apple, and Tesla began slipping, automated programs sold billions in milliseconds, reinforcing downward momentum. Human investors saw prices dropping, panic set in, and the algorithms sensed more sell signals. Within hours, the market spiral became self-reinforcing. Meanwhile, corporate fundamentals did not immediately justify a 70% drop. Revenue, profit, and growth projections remained strong, but sentiment overrides fundamentals in extreme conditions. The illusion of invincibility had built up a fragile system, and once fear entered, it overwhelmed reason. Confidence had been artificially inflated, and now confidence evaporated just as quickly. Institutional interconnectivity magnified the impact. Mutual funds, ETFs, pension funds, and derivatives linked their assets in ways few understood. When one asset dropped, collateral requirements, margin calls, and rebalancing orders triggered forced sales in others. The three companies, Nvidia, Apple, Tesla, acted as bellwethers. Their declines signaled risk to other tech equities, leading to a broad market drawdown. Short sellers, once cautious, now moved aggressively. Bets against the overvalued tech giants multiplied. Media coverage amplified fear, showing red headlines of plunging stocks and market panic, which in turn influenced retail traders to sell. The collapse became not just financial, but psychological. Underlying all of this was a hidden structural issue: concentration risk. A disproportionate amount of capital was tied to a handful of companies. When Nvidia, Apple, and Tesla faltered simultaneously, trillions of dollars of wealth moved virtually overnight. The system had been optimized for gains during growth, but had no cushion for a simultaneous correction. The second part of the story lies in global supply chains. Nvidia depends on semiconductor fabrication in Taiwan, Apple on complex international manufacturing, and Tesla on raw materials and batteries sourced worldwide. Any disruption, geopolitical tension, energy price spikes, or logistical bottlenecks amplifies investor uncertainty. In 2025, a combination of regional conflicts, shipping delays, and rising raw material costs created the perfect storm. Investors feared margins would compress, revenue projections would fall, and growth narratives would collapse simultaneously. AI-driven speculation intensified the effect. Nvidia's dominance in AI hardware and software had made it a favorite for hype-driven funds. Tesla's self-driving promises and Apple's rumored new hardware innovations attracted speculative capital that valued potential over reality. When early signs of production slowdowns, regulatory scrutiny, or market saturation appeared, automated trading systems interpreted any deviation from perfect growth as a signal to sell. The faster AI-based trading acted, the faster human panic compounded it. Derivative exposure further magnified losses. Options, swaps, and leveraged ETFs tied to Nvidia, Apple, and Tesla created a chain reaction. When stock prices fell, derivative contracts triggered automatic losses and margin calls across global markets. Institutions with exposure to all three giants simultaneously were forced to liquidate positions to meet collateral requirements, reinforcing downward momentum. The collapse was not just in isolated equities, it was systemic. Investor psychology played a crucial role. For years, these companies were treated as untouchable. Retail investors chased momentum, institutional analysts endorsed overvaluation, and media narratives reinforced invincibility. When fear entered the market, the very same confidence mechanisms worked in reverse. Traders who once bought on hype now sold on fear, creating cascading red flags in charts and algorithms. Behavioral finance amplified mechanical systems effects. The simultaneity of the drop, Nvidia, Apple, Tesla, also had symbolic significance. These three represented the pinnacle of tech-driven growth. AI, consumer technology, and renewable energy/EV innovation. Their collapse shattered illusions of sectoral immunity. Funds that were over-concentrated in future-proof technology faced immediate reassessment, creating additional downward pressure across correlated equities. Long-term consequences extended beyond stock prices. Corporate investment slowed. Supply chain expansion paused. Venture capital funding for tech startups contracted. Even broader indices reflected the shock as correlated sectors, semiconductors, consumer electronics, clean energy, fell in sympathy. Trillions in market value evaporated in weeks, shaking confidence in growth-focused tech portfolios globally. The lesson is structural. Extreme concentration, leverage, automated trading, and speculative hype create fragile systems. When multiple high-profile assets face simultaneous stress, the effect is magnified exponentially. 2025 proved that even giants like Nvidia, Apple, and Tesla are vulnerable when human expectation, artificial intelligence, and systemic leverage align against them. By the end of the crash, the market was not just down 70% for three companies. It had recalibrated investor expectations for the entire tech ecosystem. Confidence returned slowly, but the psychological scars and regulatory scrutiny left a permanent mark. The simultaneous collapse of these three titans was not random. It was an inevitable outcome of a highly optimized, yet dangerously fragile, financial system built for growth, not stability.